Good afternoon. Welcome to the Next of Our Essential series. These are topical, engaging, and technical webinars from leaders in the private client world. I'm Lottie, founder of the Jura Society, network and private client consultancy focusing on women, wealth, and well-being. This afternoon, I'm delighted to bring Olivia Burke, Associate Portfolio Manager at Brown Advisory, in to educate us on an introduction to investing and financial wellness. We're going to have any time for questions in the chat. If you pop them in there, we'll reach them at the end. And if you have any questions following this, then please do get in touch. We'll be on record and also streaming live to you right now. So I'm just going to get Olivia to join us now. There we go, Olivia. Over to you.
Thanks, Lottie. Good afternoon, everyone. And thank you for joining us. I'm very pleased to be part of the Essential webinar series for Jura. And my hope for the time that we have today is that you'll come away with a greater understanding and hopefully a bit more confidence in how to manage your finances and maybe your family's finances as well. So if we can get the first slide up, Lottie. That's great, thank you. So I'll first just say a little bit about me and what I do, and then we're going to touch on the financial landscape for women right now. We'll talk about some practical tips to take control of your financial well-being, and then we're going to do a very, very quick maths class, which will be simple. Finally, we'll do some phrases and jargon at the end. And as Lottie said, we'll have a little bit of time at the end for questions. So if we just, so as I said, I'm Olivia Burke. I'm an Associate Portfolio Manager at Brown Advisory. That means that I work with a team of portfolio managers and analysts helping high net worth individuals and families and foundations manage their investments. So we are a independently owned company. We've got over 800 members of staff globally. We've got over 80 in London, and primarily based in the US with a presence in Singapore, Germany, and Japan. So my career thus far wasn't a straight line. I bounced around a little bit. So I studied English and North American literature, which is very different from a lot of people who end up in this industry. At that point, I thought I wanted to work in fashion and celebrity PR. Didn't turn out that way. Turned out that wasn't what I wanted to do. I got on the grad scheme for Deutsche Bank. And I was the communications graduate for a while, so I was ghostwriting the emails that went out to the firm, and then I moved around operations and middle office for a range of different companies. So the investment bank, I worked at a derivatives market making trading floor, and then I settled in wealth management about 6 years ago. So I've been at my position. I've been at Brown Advisory for about 2.5 years now. And I finally think I've settled on what I want to do after moving around a little bit. So that is plenty about me. If we just go on to the financial landscape for women at the moment, and we've got a few stats that I think tell quite an interesting story about where we are and where we've come from. So we have 80% of women will be solely responsible for their finances at some point in their lives. I actually think that seems a little bit low. But just something bearing in mind that whether you know about finance and investing or don't, there's a very good chance that, education or not, you will have to make decisions about finances. So we're better knowing more than less. 5 years, the average number of years that women will live longer than men. So your money needs to potentially last you longer if you plan on living longer. 33%, the percentage of global wealth that is held by women. So still a way to go, but significant. $30 trillion. So that's the amount of wealth that is expected to be inherited by women in 2030. And that's an unprecedented amount of wealth transfer. Just for context, that's more than the GDP of the US. So it's an interesting change in the landscape looking forward. 58%, the percentage of single person homes in the US that are owned by women. So of the homes that are owned by one individual, more women are buying houses than men. And then 49% of new businesses started in the US in 2021 were by women. So we're nearly at half, and that is up really significantly from the 28% in 2019. So I think this shows, as I said, that there's still a way to go, but it's really promising. And I think it's really exciting if we sort of see women as this emerging market who have all this room to grow into. But it also means that we've got a responsibility if this has traditionally not been our place in society, or wasn't our mother's place, or wasn't a way that we talked about it around the dinner table. We've got work to do in terms of getting educated and making these types of conversations and sharing this type of information as commonplace as perhaps men do. So if we just move to the next slide. So you can see here that, as I said, because we've got this ever-changing landscape, particularly for women, we've got this range of different confidence levels amongst the different generations. So if you look at this top left here, and you can see that female, where it says female, and then boomer, Gen X, millennial, Gen Z, there's this increasing confidence about the future of women's own wealth. And it's warranted because women's wealth has increased. But up until Gen Z, it's always been either the same or less than what men anticipate that they're going to earn in the future. So you've got this shift when we get to this younger generation of women who obviously feel confident, and as I said, rightfully so, because they're about to receive a lot of money. And then if you just look to the chart at the bottom, how that is different for actual confidence levels and decision making. So, if you look top one, this is a confidence surrounding investment decisions within a retirement account. So that's 7% of women are mostly comfortable with making investment decisions in their retirement accounts compared to 18% of men. And on the flip side, 37% of women are not comfortable making decisions around their retirement accounts compared to 19% of men. So we're seeing this increase where women are confident about getting money, whether that's making or inheriting. They're confident about the future where they know that they're going to have more money. But when it comes to having money and making decisions about that money, there's this disparity. So as I said, we need to do some work, I think, A, on self-esteem, and B, on education. So if we just move on to some of these sort of practical tips that, they won't apply, not every single one of them will apply to everybody. Most of them will apply to most people at some point in their lives. And if you follow these tips, you follow this sort of checklist, you should be in a pretty good financial position. That might not necessarily mean that you have an enormous asset base, but you'll know what you need to do to get to where your goals are. So the first one is pretty simple, and everyone can do this. Understand your current financial state. And it can be really intimidating, especially if there's some debt, or if you sort of get to the end of the month and you kiss the magic card and just hope that your payment goes through. That can be something that you just don't want to think about. But it's worth doing because, well, you're not actually going to get yourself in a good position unless you know where you're moving towards. And I would recommend that the way you do this is by listing what you own and what you owe, so your assets and liabilities, and then what you earn and what you spend. So it's a balance sheet and an income statement. And it doesn't need to be super granular where you're listing every penny or every time you've bought a Starbucks, but it does need to be honest. And then once you can see that position, you can work out your net wealth. So what you own minus what you owe. That's going to be your net worth. And you can also see where you're doing silly mistakes that you don't even realize you're doing. And, I go through this exercise a couple of times a year. Really doesn't need to be much more than that. And without a doubt, every single time I will find, a direct debit that I just completely forgot that I'd signed up for, or I'm paying way, way too much for a phone contract. So just doing this exercise can actually put you in a better position as well as orientate you. So the next 2 points I'd say would sort of come together is you have to work out where you want to go. What are your actual goals, and are they realistic? And it's really important that you put a time horizon with those, because you need to have a time horizon to know if they're achievable, and you need to have a time horizon to know exactly what you can do during that sort of planning period. So, for example, I bought a home a few years ago, I decided that I was only going to save for a couple of years. It was not a long-term saving plan. And after that point, whatever I had, I was just going to buy the house I could afford. So if I hadn't thought about that as a timeline, I might have started putting those savings in the equity markets. And that would have been far too short a time period to invest in equity markets. Equity markets over the sort of short term are volatile. I could have ended up losing a lot of money and not meeting my goal, or being forced to sell equities when they were far below what they should have been in order to buy a home. So you really need to think, when am I going to achieve this goal, and what can I do during that time period to achieve it? So the next one won't seem like it applies to everybody, but building your team of trusted advisors. So, most people will interact with a lawyer or an accountant at some point in their lives, but I would caveat this with not just advisors in terms of, a formal relationship that you pay for. I would say that this can also just be resources. You're not going to be an expert on absolutely everything that you need help with in your life, but it's important to know where to find that information. So whether that's just friends, people in your network, a useful resource that you found, a forum, free advice, make a note when you come across things or people that are helpful that you can either get information from or you can exchange skills with, and share that information as well amongst your friends. Talk about it, because these will be the people and places that will help you out when things get stressful. And then the next two points are understanding stewardship, legacy, and gifting. And I think these go together quite well, because what it really means is remembering that your money doesn't just affect you. So you may have children or a partner, or you may be the recipient of inheritance from parents or grandparents' money. So it's thinking about how money interacts with the people who didn't make it, or the people who own it today but might not own it tomorrow, and having those conversations sooner rather than later, and working out exactly what that picture looks like. And just going back to point 4, whether that's getting help from a trusted advisor or doing a bit of research in the meantime, just thinking about that in the medium and long term. The same for strategic tax awareness and planning. If you're not a tax accountant, you might think that sounds very boring, but almost everybody has the capacity to have a reasonable understanding of their own tax situation. And by that, I mean what tax you're paying, what you might pay if certain situations arise. Are you using tax-free allowances? Are you using tax wrappers? Those sorts of things can save you a lot of money and can prevent you from making a lot of important mistakes or a lot of punitively expensive mistakes. So think about it. Don't bury your head in the sand. You have the internet at your fingertips, and you can very easily get a good understanding of just the day-to-day of your tax position. And beyond that, obviously, there are lots of incredible professionals that you can reach out to. And then finally, plan for and protect against risks. You'll never be able to field every single risk in your life, but you can think about the top things that might affect you, and you can put guardrails up where possible. So, can you afford to pay your bills if you or your partner got sick? Can you afford to pay your bills if you or your partner lost their jobs? Is there, legislation that might come in the immediate future that could negatively impact you? And if so, is there anything you can do about that? Just sort of checking in with these things every now and again, and being conscious of them, so that if anything like that happens, you have some sort of a plan or an awareness. Okay, and then this is just a quick review of how to do that initial planning point that I said. Just a few things to think about. I won't read them all out, but I think a couple of points to focus on. Do you know how your homes are owned? Do you consider that a £600,000 house is part entirely of your assets, or are you just going to put the equity in there? Because actually, if you're being honest with yourself, your asset base is just the things that you truly own, and you should have an awareness, whether you pay the bills or whether somebody else does, how that all works and what that looks like. Have you reviewed insurance? And I think that shouldn't just say insurance. I think that should be lots of different direct debits, or just the normal lifestyle expenses that you have week on week. Are you doing things because that's the way you've always done them, Or have you actually thought, hang on, is there a way that I can have the same experience but cheaper? Or do I even really need these things? Okay, now this is the quick maths lesson that I was talking about. Oh, there we go. So once you've got investments, and so you've got an equity portfolio, or you've got a portfolio of different types of asset classes, there are a few different things that can affect what those returns end up looking like. And there's some obvious ones and there's some not so obvious ones. So the obvious one is what the investment is returning. So if you have two portfolios with the same amounts that you initially invest, and one of them is going to return 10% a year and the other one's going to return 1% a year, then obviously the 10% one is going to do better. So first and foremost, you want to make sure that whatever you're invested in, you're getting compensated appropriately for the risk that you're taking. The second one is the direct costs. So we know about tax, we know about fees, but you need to always think about your investments net of those things. So your investments, or the return on your investments, is what is going to end up sort of back in your pocket. So you need to make sure that you're making use of things like ISAs and pensions and things where you can benefit from not paying tax completely legally, and that you are being charged an appropriate amount of fees for the service that you're being provided with. Third one is the one that we hear about all the time. That's inflation. So if your portfolio is returning 3% return, and inflation is 3.5, then you're simply losing money. And you might have chosen a lower risk portfolio because you don't have an appetite for risk, but it is obviously intrinsically risky to continue to lose money and have it eaten away by inflation. And if we just refer to the chart that's in front of us here, so scenario 3, the yellow one, so that is just money held under the mattress, so it's got no return. It's not going to be keeping up with inflation at all. It's actually going to be eroded by inflation. The middle one, the pale blue, so that is a safe portfolio that is producing a 3% annual return. And as you can see at the top, it says that inflation over this period is said to be 3% annualized. So that means that you are literally just preserving the wealth. You're going to have the exact same amount of spending power over time. The number will go up, but it's actually not going up in real terms. It's not going to provide you with a better quality of life. It is worth essentially what it was when you put it in. And then the scenario 1, so that is a diversified portfolio producing 6% annual return. So the real purchasing power growth of that money is going to be the 3%. So it's the 6% return minus the 3% annualized inflation. Oh, sorry, we have one more. Hang on. There we go. So the fourth thing, that is the one that we don't think about, the fourth thing that can affect how your returns look in your portfolio, is withdrawals. So obviously everybody knows if I take money out my portfolio, it's not going to be there. But what you might not think about is what that money represents. So let's just say I have some numbers in front of me. There we go. So let's say you have £20,000 in a stocks and shares ISA, and it's returning on average 7% a year, and you decide to take £8,000 out to buy a car. And so you think, right, well, I would have made 7% on that £8,000. So for the year, that withdrawal has cost me 7% times 8,000, that's £560. So after the year, you put the money back in and you think, all I lost is the £560. I lost 7% on the 8,000 that was out for a year. So actually, you lost that £560 times the amount it would have compounded over the period that you plan to invest, which sounds more complicated than it is. But if you think about it, if you'd have left that £560 in there, so you left all the money in there, you didn't withdraw anything, after 1 year, that £560 would have become £600 because it would have got 7%. And then the £600 times 7% takes it up to £641. So after 10 years, that £560, had it have been left completely alone in the portfolio, is worth £1,102. These are approximate numbers as well. It's not a real world situation. You wouldn't have the exact same return every year, but we'll just talk about it in approximates. After 30 years, that £560, had it been left alone, continuing to compound at 7%, is 4,263. So it's not just 560, and this isn't to scare people off and say never take money out of your portfolios or never use your own money. Absolutely do. Your money is yours and it's there for you. But you should think about it in terms of not just withdrawals, but also contributions. A small withdrawal or a small contribution has an impact. If you're thinking, oh, I don't have enough money to save, or I've only got £100 to put in my ISA, that £100 after 10 years will double, and then it'll double again, and then it'll double again. So it's always worth doing. It's always worth thinking about whether or not a withdrawal or a contribution is the right thing to do. So in terms of accounts, what's happened with this? So in terms of ways that you can invest, we think about this as a waterfall of savings, and all that means is you should fill one bucket up to the top, and then if you've got money left over, you fill the next bucket up, you wait for that to go to the top, and then the next bucket. Now, the world doesn't work like this, so that's sort of what you should do in a perfect world to get the best sort of long-term outcome. So if we think about pensions typically go in pre-tax, so that's gross of whatever your salary is, and then when you withdraw from them, when you're 60, 70, whatever, you take the withdrawal and pay tax on it. Now, typically most people, when they're 30, 40, 50, will be paying a higher tax rate than when they're 60, 70, 80, 90. So that's where that sort of benefit comes in, not to mention the fact that these are the longest term investment pots, because you start them young and you don't take them out until you're older, and you're not allowed to either. So that gives them the longest amount of time to compound, and because you're putting this larger gross sum in at the beginning, it's going to obviously be a larger investment at the end. So the other important thing about pensions is that most people who work for an employer, who do sort of, work on a sort of PAYE basis, will have the opportunity to have their employer match part of their contribution, and that's free money. So you should always do that. So if you start with your pension, providing you don't need to take that money out, and then next one down is your ISA. The downside of that, obviously, is that it is not pre-tax income that you're investing; it's post-tax income. So you're investing net of paying your normal income tax, but it does grow tax-free. So you can put £20,000 in an ISA every year. If you're under 18, you can put £9,000 in a junior ISA every year, and whatever the gain is on that, whatever the dividends or interest from the assets within that ISA, they are completely tax-free, providing that you are only paying tax in the UK. Other jurisdictions make it a little bit more complicated. And then the final part, so let's say you've topped your pension up to the maximum, you've put £20,000 in your ISA, and then you have some money left over. The next part is your taxable normal investment portfolio. So that's similar to sort of like those, everything from a managed portfolio, like what we deal with, right down to just the digital apps. I think I've got one on Monzo, and so you can take them out whenever you want. They're very, very flexible, but they are taxed both at input and when you withdraw. Okay, and then these are just the numbers to show you really what that compound interest tax-free looks like. And as I said, these are not that realistic because it's very unlikely that you would have the exact same return every single year, but it's just worth seeing that from a relatively small investment, adding, the full allocation, the full 20 grand every year, you can see if we sort of imagine that you were 100% in say large cap equities, and you're going to have somewhere between this 7 and 10% return, that's an enormous sum of money. So just something to bear in mind. Always fill the ISA before you fill the taxable account. Okay. So finally, I just thought we'd do a little bit of jargon busting, because I know that there's certain things that people hear in sort of day-to-day conversation, and because they're used so casually, maybe people don't feel like they can ask what they mean. And so I looked at investment and finance's most Googled questions and phrases, and some of them were too easy, like what is an investment? But I thought these were some that were quite interesting. So Real Estate Investment Trust, which you may have heard of. So this is a publicly traded company that owns or operates or finances properties. And all that means is it's a type of investment that will gain you exposure to the real estate industry without you having to physically go out and buy a property. They also pay quite good dividends. So it's actually a good way for people to receive passive income. Why is inflation so high? So I'll just talk about this from a UK perspective, because slightly different scenarios for different countries. So one of the main reasons is during the pandemic, people saved up a lot of money because they didn't have anywhere to spend their money. There was also a lot of government stimulus projects. They built up this desire to buy things, and then the world opened again, and then you've got all this demand for travel and goods and services, and the sectors and industries that provide those things struggle to keep up. So when demand goes up, supply goes down, and then prices go up. The other thing is obviously the war, the Ukraine-Russia war, that increased oil and gas prices. So that always that flows down to the average person, because we all need to use oil and gas either in day-to-day or via the products that we use. Brexit, we left the EU, and that created some barriers to trade. Those barriers are costly and they cause delays. So again, that feeds down to the net importers. The UK is a net importer of food and drink. So we've had some freak weather events, and those have been damaging to agriculture, and that sort of flow down to countries like the UK, lead to greater costs. So, and then finally, what is a passive index tracker or an ETF? ETF stands for exchange traded funds. And so if you have one of those sort of digital investment accounts, perhaps a Hargreaves Lansdown, or a Monzo or a Plum or a Starling, you may have seen these. So these are pooled for track something else. So they aren't actively managed. So if you think about an exchange or a particular sector, these will try and mimic the performance of those assets. They tend to be very cheap. They tend to be slightly less volatile, particularly when they're invested in larger sectors. And they don't require any management from you. People tend to put money in those and then sort of leave them to do their own thing. So that was everything from me. Lottie, I don't know if we've had any questions over the last few minutes.
Hello, thank you so much, Olivia. Fascinating. And I think it's really, really important to actually understand the tax implications as well. So thank you for giving such a clear overview of what the priorities in a textbook perfect environment scenario would look like, because I think a lot of people are a little bit anxious over, investing in the first place, but then it's where do they put it? And what can they do next? What takeaways can we do? I think one question is, what does a portfolio manager actually do?
So I think actually in your, it was one of the other webinar series, somebody talked about how confusing the language in wealth management is. So you have different types of portfolio managers. So portfolio manager on the wealth management side is our clients. We deal face-to-face with our clients. Our clients have portfolios of assets, and then we decide, what goes in, what percentage we put them in at, when we sell, and what will be appropriate for them given their needs with their lifestyle, and also any sort of restrictions they have around investing. So you can also have a portfolio manager who just manages a single fund of his own, and then people just invest into and out of that fund. And we have those on the other side of the business as well, which makes it a little confusing. But I would say for my role, it is largely client facing, and then I face sort of internally to our research analysts and our fund manager analysts.
Perfect. Yeah. So it's decision making on behalf of the clients for their best interests, really. So, you are the one monitoring it. So it takes the time and the effort and, some of the stresses, because you have to consider all of those things that you've just run through, which takes that off the side of the client to think, oh gosh, is this a good time to buy or sell? Or what's the tax implication of this? It takes all of that heavy lifting, let's say, over to you. That's brilliant. And then let's just talk a little bit about if somebody wanted to do this role, how would they get started?
So I think there's a few different routes into it. I wouldn't necessarily recommend that you study English literature and then work in fashion PR and then be the communications intern at Deutsche Bank. There's probably some more direct routes. So I would say the fastest and probably most straightforward route out is the sort of entry level position. So we travel around lots of different universities and we advertise our grad scheme, and lots of our competitors do the exact same thing. So that gets you in at the very ground. If it's a sort of sideways move, I would say the most important thing is to read everything you can get your hands on, have a good knowledge of what's going on. Mostly in the bigger markets. I get a lot of people asking me about sort of UK news and UK financial markets. When you're a portfolio manager, you have to look at the entire world. So lots of global news sources. And it also can't hurt to you can do some qualifications beforehand. So there's something called the Investment Management Certificate, the IMC, which can be done in about 6 months. And when we have sort of work experience with people and grads who come in, I always say to them, that's a really good way to get a foundational understanding of the business and, sort of investments as a whole.
Yeah, definitely. Because it is another language as well that we don't usually discuss in our day-to-day lives. And once you know the notes, you can play the song. So I think that, having any kind of understanding of some of that jargon and being able to contextualize it is essential. And then let's talk about more of the practical stuff. So in terms of actually, say, investing with you guys at Brown, how would that work?
So we get, clients from a number of different pipelines. So we have sort of website inquiries, which are kind of just people cold calling us. I take quite a lot of those. We get referrals from existing clients, lawyers, tax accountants, that sort of thing. And then we do an initial meeting to assess whether they're appropriate for us and whether we're appropriate for them. The way that we invest and the way that our fee structure works is that we don't have official stated minimums, but we look for somewhere between either existing or a clear runway to $3 to $5+ million of investable assets. And where we can't help or we're not suitable for somebody, we always know good people in the industry that we can refer out to. And I also would just caveat that with, if you're hearing that number and think that sounds enormous, that is not indicative of how much money you need to invest or to have a portfolio or to have savings. That is just, unique to a business that deals with ultra high net worth and high net worth individuals.
Yeah, absolutely. And again, I think if you're having a client for life, basically, because these are relationship-based relationships that we have as professional advisors, and it might be a family that's coming on board with you, or looking for the long term or for the next generation as well, where you actually continue that through, because I think consistency is really critical, especially when there's a lot of uncertainty in the world. For instance, knowing that you're with a safe pair of hands can help to mitigate some of that anxiety, especially when you're dealing with larger sums of money.
Yeah, definitely. And I think also the family point is a really good one, because you can have a family who perhaps see their investments maybe not as the same investment plan, but they recognize that there's going to be some movement from the say the parents of the children, and you could have somebody within that family who has a completely complicated situation. So they have a unique tax status, or their money is in a trust that's been structured a certain way. So having that holistic picture of where the money's being, who it's going to impact, and where it's going actually has such an impact on how we would invest it. It makes it, in a way, it makes our job easier to have more of the family involved in the relationship than just individuals.
Brilliant. And we've just had another question pop up here saying, is there a demand to have philanthropic trusted advisors that are not part of the financial services to gain insight to the philanthropic needs on the ground? Or how would you go about connecting them? So I suppose that's establishing the philanthropic needs of the clients subject to the financial, separate to the actual financial needs of any of their giving, I guess.
So sorry, as in if we had a client who came to us and was interested in sort of implementing a philanthropy strategy alongside, I mean, we don't have somebody on the ground, we don't have an individual in-house. We have our strategic advisory services, so they know sort of the implications of the tax and how to sort of plan that for the long run. But actually we do tend to refer people out sometimes, or people will come to us. So we have people who have donor advised funds, and we manage those investments on the understanding that over a period of time they are going to be donated out. And so we know a few providers of those, but we're always looking to be introduced to more people. So if somebody who sent that is one of those people, then absolutely get into it.
Fantastic. That's what we're all about, collaborating here, connecting good people to each other to do good things, I think is spot on. Well, thank you so much, Livia. That was truly, truly insightful. If anybody does have any questions, if you're watching this on the replay, hello to you. But thank you so much for this afternoon.
Oh, thank you so much. Take care.
See you.
Bye.
Bye-bye.